All down. All silent. Going. Go. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another edition of Current Market Insights. I'm your host, Kieran O'Brien, and with me as always is my good friend and co-host, Mr. Peter O'Malley. Peter, hello.
Kieran, great to see you.
Great to see you, Peter. Also a very warm welcome again to our listeners. We did have a week off last week due to illness, so it's nice to be back in the booth. I want to kick off tonight, Peter. There's actually been a lot happen over the last couple of weeks, but one of the things we have intended to talk about now for a few days revolves around REA, or realestate.com.au, which, as many people know, is one of the biggest, if potentially not the biggest, real estate websites or portals in the country. And some information's come out
in the world.
In the world,
certainly is in the country, but yes, in the world.
They are enormous.
Yeah.
They certainly are. But some information's come out over the last few weeks talking about their profits and how the business is performing in the marketplace. And we thought it might be a good idea just to dissect a little bit about what that statement is and what really it means for consumers in Australia and whether or not it's something they should really be wary of.
Kieran, the reason I was keen to point out that it's the biggest property portal company in the world, or one of, is because Australia is the most expensive market in the world for a consumer to advertise their home.
Right.
And it has been the case for some time, but every year advertising on these website portals gets more and more expensive for real estate agents and consumers. So when you ask, well, what's the relevance for a consumer in how good or bad realestate.com or any other website portal are doing, the reason consumers should take a cursory glance or interest in it is, at the end of the day, it's the consumer that are paying these rates. So in my time in selling real estate, I don't think I can ever remember a year where realestate.com's revenue went down. I can only ever remember price freezes from these website portals, and this is partly due to the mass migration of advertising from print into the digital age. But there's absolutely no doubt that real estate consumers are now paying 7 to 10 times what they were 15 years ago to advertise their property on the internet, and they're paying, as I just mentioned, the highest price across the globe. And that's why we're seeing headings like this one here. REA Group, which is the parent company of realestate.com, reports a 23% revenue bump in financial year 24.
Right. So there's a couple of things to dissect here, I think. One, we should certainly look a little bit closer at what that 23% means in real terms for people to get some concept of how big they are. But as a consumer and someone who may want to engage the services of a portal like realestate.com for their sale, I guess my first question is, can you, as a standalone consumer who doesn't want to use an agency, get yourself on these portals if you did want to sell your property?
There are firms that specialise in helping consumers market their home on these firms without a real estate agent being involved. I think Domain are probably more open to a private advertiser going on that platform than realestate.com may be. But there are, as I say, specialised firms that facilitate private sellers going on the platform. So yes, if you do want to go it alone without an agent, you can do so.
Yeah, but I think the point of sort of highlighting that is you still need a broker to get into the platform. It's not like it's not like this company is providing the most accessible platform in the world and saying, well, if you want to sell, please come on board. They're still saying you have to go through this model where you engage an agent or a broker, which I personally think just helps inflate the cost for them.
Look, I think, and I can't be sure on this, but I think the websites would have an avenue for private vendors, for sale by owners, as we used to call them back in the day of newspapers, would have an avenue for them so that they don't get accused of anti-competitive behaviour. But there's no doubt that a solitary home seller looking to save $10,000 on an advertising campaign, therefore not using a real estate agent but going for a budget campaign themselves on one of these websites, is not really the core market that the website portals are playing to, because the revenue that the for sale by owner is likely to spend on the website is significantly less than what a real estate agent will spend, and it's a one-off customer. Where at the end of the day, realestate.com and Domain and any website portal around the globe doesn't have a gun sales team selling their services to the consumer in the marketplace, because real estate agents do that in lounge rooms every day for them.
Yeah, absolutely. I think it is important to highlight or recognise, though, that the for sale by owner, as you say, with less expenditure, less exposure, is really at something of a disadvantage in many ways if they're not featured at all on these platforms, given how big they are. So I guess going back to a 23% revenue jump, I mean, all through COVID and even now that we've come out the other side of the worst of it, I suppose, everyone is talking about companies that are experiencing massive revenue growth in a cost of living crisis. So for a company like REA, what does 23% growth in revenue actually mean? You know, what are some signs or things that consumers might be aware of to indicate their growth?
Well, look, I think the first thing that we should point out, Kieran, is that listings in the two major markets, being Sydney and Melbourne, have actually been quite low for the last 18 months. So they've got a 23% bump in revenue on a drop in listings in their major markets. That'll give you an insight into how much the cost of advertising for those that are out there have jumped. Now, the VPA model is massive. The VPA model, being vendor paid advertising, is absolutely massive in Sydney and Melbourne, but to a lesser degree in Adelaide, Brisbane and Perth. And they're the markets that are going strongest at the moment. And if an agent wants to stand out in a booming market where stock's tight, like it would be in Brisbane, Adelaide and Perth at the moment, the surest way to do that is to advertise more and over-promote your existing properties. So you get this convenient co-op between the advertiser and the real estate agent, where the real estate agent overstates the need to advertise the property and spend on marketing as a way of the agent using that as a vehicle to promote their own services to the broader market. Where in a boom, you don't actually have to do more advertising to sell a property. You need to do less because the buyers are turning up anyway. Whereas the market tends to work in reverse, is that when the market is flat, that is when, by rights, you should be doing more advertising because you're trying to attract people on a flat track, so to speak.
Yeah, it's a really interesting analogy there. I think, you know, we talk about the REA model is agent driven. So there's a lot of activity trying to get on the platform. It's very similar to a hot market, as you say, where you don't need to advertise because everyone's looking for your property anyway, whereas the reverse can occur.
So real estate agents back in the newspaper days used to work on this premise. Whoever's got the most ads looks the most successful. Whether that's true or not is a different story. But the more ads you have, the more successful you look. And then what came about is, instead of having a quarter-page ad, why don't you give each property its own full-page ad? And that would cost that vendor more, but you'd make their property look more exclusive. And the reason that website marketing is rising year on year for the consumer and the real estate agent is the media executives know where the real estate agents could take the consumer to on real estate advertising going back 20, 25 years. So when I first started selling real estate in the inner west, Kieran, I would go into homes where the people had spent $30,000 on an advertising campaign, run an auction and not got a bid. And they just thought that was bad luck. But that was 24 years ago now. So media executives know that that is what the consumer will pay in some cases for exclusive real estate to get a sale in terms of the advertising. So that's why if you're asking yourself, is there further growth in these companies to go? Absolutely. I have sat with people that have tried, who have spent over $100,000 on advertising across 3 firms and not got a bid on their property.
That is unbelievable.
But that was really, really common.
Yeah, wow.
Really common. That's how I started my real estate career. So this is why this is a fascinating story, because we've nearly gone the full circle where the media empires have fully migrated. It's been a rough ride for them, but they have nearly fully migrated the revenue from print back across to digital now.
Yeah, in a time when it costs them far less to deliver, there's far less on their part. And you know, you and I talk about this quite a lot, but I can't help but see the irony in As you say, all these agents vying for premium advertising, trying to make their agency look good first and foremost, but also promote a property. It's become so commonplace in some markets that, as I said to you, only a few weeks ago, if everyone's Premier, no one is Premier. And we've almost reached a point where, the highly paid ad is the baseline, and someone who doesn't have that actually stands out for being a little bit different. And I think it's certainly an interesting scenario we found ourselves in.
Oh, that's right. It's like if everyone's at the theatre on their tippy toes, there's no advantage for being on your tippy toes.
Yeah, exactly.
And what's happening here in these on these websites is that they're dialing the price up in unison across all the agencies, and they all feel like they've got to be in that space. And all that's happening at the end of the day is the company's getting bigger and more dominant, and the consumer's paying more.
I guess to wrap up this topic then, Peter, if you are a consumer and you don't want to feed the beast, so to speak, other than running a very bare bones campaign on your own or using a broker or, something like that, or using an agency like yourself or an agent like yourself that works on a no risk kind of model, what options do people really have to fight against this?
Oh, the most common one is the off-market. So people think that off-market is to keep the property exclusive, but the primary purpose of off-market is let's see if we can secure a sale through the real estate agent's database from the real estate agent's website without the need to spend that $8,000-$10,000 on a full advertising campaign that may or may not work. And when we look at auction clearance rates, which we'll talk about shortly, there's no certainty that one will get a sale in Sydney and Melbourne at the moment going to market because it's a bit patchy out there suddenly.
Yeah, certainly. I know I won't be alone in hoping that there's a good third-party alternative on the horizon to contribute to the real estate market, because I think competition's good for everyone.
Oh, look, there is a third player, but history tells us that there's no room for a third player. So we've had some significant third players. Telstra went into this with a website, I think it was called, correct me if I'm wrong, I'm pretty certain it was called Just Listed.
I actually have no idea.
Yeah. Oh, yeah, Telstra were the third wheel behind Fairfax and News Limited. And James Packer followed Telstra with a website called My Home. Again, correct me if I'm wrong, but definitely Telstra and definitely James Packer in the very early 2000s attempted to be the third wheel unsuccessfully, and they packed it in and accepted that market dominance remained with realestate.com and Domain respectively. Domain being Fairfax at the time. Domain is now it's a publicly listed entity in its own right, majority owned by the Nine Media Company, I should say. But the third wheel in the marketplace at the moment is actually twofold. It's real estate agents' websites, as I've just described to you, and it's a website called Homely, which most people have probably heard about, but it's not at the forefront of their mind, and it's certainly, based on the lack of inquiries that we get from it, it's not a website that the consumer is going to. But when you say to people there's a third real estate website, Homely, they go, oh, yes, of course, I've heard about that. But Homely seems intently focused on getting itself to enough of a disruption for the majors that it's purchased. I do know that Homely is majority owned by real estate agents now, and the real estate agents are hoping that they can get it to a point where Homely attracts more of the consumer eyeballs to take them away from the two majors. But the reality is it's not happening that way. And, I can't speak for the people at Homely, but I think they're trying to get it to the degree that maybe an international conglomerate private equity who wants to break into this very lucrative real estate advertising market in Australia takes out Homely and then gears it up to the next level, or one of the two majors just buy it to shut it down. But Homely costs essentially nothing for real estate agents to advertise on. So you can see that on some of these major portals, some of them cost $2,500, some cost $3,500, depending on the price or the value of the property and the suburb and the postcode of the property. And then you've got Homely, which is zero, but no buyers are using it, so therefore it has no value. It costs you nothing and it essentially gives you nothing.
Yeah, certainly a good recap, Pete. I think the horizon and the future is certainly interesting for real estate. I'll be keeping my eyes on the marketing space, that's for sure. Speaking of international interest, I just want to quickly talk about something I heard today, an announcement from the federal government talking about plans to restrict international students coming into Australia from next year. In some way, this is a muted response, I guess, in my opinion, to the massive immigration influx that we've had over the last few years, which has certainly contributed to some of the housing stress. Some of the initial reports, I did some, back of napkin calculations myself, just to get a rough guide on what kind of impact we might see here, and using an average cost for an international student to study here at university, we may see somewhere in the order of $1 billion in lost revenue to our higher education centres. There are some reports from some consumer and lobby groups suggesting that, in fact, the real loss here might be roughly $4 billion. Now, that's talking about real loss in terms of economic impact on businesses, etc. I'm really interested to get, firstly, your thoughts on this announcement, but also your thoughts on whether you think this is likely to impact or potentially spook investors who do rely, in many cases, on those students coming in and renting their properties around the universities that, have catered for this demographic for so long.
Look, I think this was an announcement, an easy announcement for the government to make, because you've got people concerned about the number of people coming into the country, and a big part of that is the international students, as we know. And then you've also got this thing about international students taking the places of locals here, and the international students being judged on a much softer metric by the universities to get their degrees and head off again. And that's an issue that I don't pretend to know the university system, but that's something that you've been hearing on the outside for a long time, right? Is that the international students are not judged, by the high standards that locals are. So this announcement from the government actually was one stone, two birds. It was pretty good. Iron ore has dropped sharply in the last 3 to 4 months on the back of China cooling. It's had a little bounce in the last week, but iron ore is down very sharply. So if iron ore is going to be down, depressed below $100 a tonne going into next year, I don't think the government will be giving up any revenue to the tune of $4 billion. I think you're seeing something here that's a little bit like the announcements they made last year when they said they're going to strongly cap the number of people that come into the country verbatim, and then they actually accelerated the number of people that came in. So if I was an investor, I'm not saying I would go out and buy a property just because I think international students will continue to come in to the Sydney and Melbourne markets, but I would not be planning around this announcement today. There is no way in this environment that the government will forego $4 billion in revenue.
Oh, I think that's a reasonable position. I guess my only question really on this topic then, other than those, is do you think that if the government does go ahead and limit 20,000 students next year and potentially accelerates that number the year after, or not that they announce that, but whatever their plans may be, do you think that would actually make any real tangible or have any real impact on the rental crisis that we are seeing in our cities, our major cities anyway?
Well, you just need to do the numbers. Does a 20,000 less demand resolve the rental crisis? And the answer is no.
Not even close.
No, it might alleviate it to some degree, but the reality is that it won't alleviate the crisis. No, it'll impact companies like Scape, which have got massive amounts of buildings around Sydney and Melbourne and Brisbane, I think, catering for international students. So it might impact their business model, but in terms of the retail investors or the mum and dad investors that you're referring to who might have bought a property in Camperdown, but you're thinking they might choose another area now because the students dropping out around Camperdown will impact the rental market. No, there'll be still 2 or 3 tenants to take their place. We'll find out in January when the new year begins, and as you know, in this real estate office, Kieran, every January you've got to really sharpen up on your Mandarin because you've got kids phoning from Shanghai and Beijing trying to lease properties over the phone, right?
Oh, look, absolutely. My Mandarin's terrible.
Yeah. Well, mine's not so crash hot either, but they're here and they just pay cash 6-12 months in advance, right?
Oh, look, they do. And
Give us the bank account number. We want the property, and they just pay it straight out. You think the government are going to turn that sort of money away?
Oh, look, absolutely.
No
And again, the university fee thing alone is a huge thing. I know, universities like the University of Sydney receive billions of dollars in fees annually from international students. I don't think they'd be allowing this to happen that easily. That's going to impact their core business model, right?
Yeah, and that's right. And that's where the government needs to be really careful here about making big announcements and not delivering, because people become really, really cynical about it. And, it was 12 months ago that Anthony Albanese said that he was going to curb migration, and all that's happened since then is it's accelerated. And you can feel it everywhere you go. So, out and about in Sydney on the weekends, in peak hour now, you can feel the people pressure applying almost by the month.
Oh, look, absolutely. It is. The city is feeling congested, that's for sure. As we wrap up tonight, Peter, I'd love to take our listeners through our usual market wrap. Keeping in mind, it has been 2 weeks since we spoke about this, so unfortunately I can't comment on whether or not you've been right or wrong on the midweek auctions being better or worse than the weekend auctions. So if you can, give us a bit of a rundown of what's been happening across Sydney this week.
Oh, well, look, the weekly auction clearance rate for this week ending 25th of August is a neat 50% clearance rate. Now, that's actually reasonable because the week before the auction clearance rate was 48%, and the week before that it was actually 44%. So that's the lowest auction clearance rate we've seen this year, or for quite some time actually, 44%, which was 3 weeks ago. There's a trend that's happening the couple of trends that's been happening in the market and continue. Yes, the Saturday auction clearance rate is comfortably outstripping the midweek clearance rate. So on Saturday, the clearance rate in Sydney was 51.4%, where the midweek clearance rate was 46%. But if we go to the numbers, there's more properties selling prior to auction than there are under the hammer. And there's quite a significant reschedule or postponed rate where the agent's getting to Monday before the auction, so to speak, and saying, Mr. and Mrs. Vendor, I don't have enough people to justify or risk running an auction on Saturday. Let's push it out 2 weeks and we'll see how we go. Those rescheduled auctions are not factored into the failed campaign numbers. But what's happening is they're all forming out the back because stock levels have accelerated across the board very quickly. And you've got a number of postponed and rescheduled auctions all ready to compete against each other in the next 2 to 3 weeks. So vendors need to be really smart about how they play this market and how they handle offers they receive on their property, because there are some challenges that are brewing in pockets of the market.
That certainly sounds to me, with all of these auctions being pushed back, like you say, and the evidence is really clear at the moment that listings are surging. There's a real risk, I would say, that if these campaigns go poorly, we could see a plummet in this auction clearance rate, even further, potentially.
Yeah, well, look, I think you'll find that a lot of people would opt to withdraw their property from the market and try and hang on for the rate cuts that have been promised or suggested are coming down the pipeline. Commonwealth Bank, for example, are cutting their fixed mortgage rate, telling their clientele that they still expect a rate cut in November, whereas 2 Fridays ago, the RBA, in a parliamentary hearing, flat out said there will be no rate cuts in 2024 because inflation is still too high. And unfortunately, that's not what a lot of families want to hear, but that's the facts of the matter. So nobody really knows where all of this is going. You've just got to follow events and draw your own conclusions and make sure that you never get caught in a situation selling your property at a suboptimum time.
Yeah, good advice. I think as we wrap up tonight, that's certainly the take-home message for our listeners is follow events that are happening around you and do your own research, no matter how you're transacting in property at the moment. And I certainly know that my goal here every week, and I know yours as well, is to try and simplify that for people to make sure that the events happening around them are as easily digestible as possible. So in that vein, Peter, look, thanks again for coming in and talking this week. Apologies to the listeners for the break over the last couple of weeks as we battled through a few things, but certainly nice to have you back on deck, Peter, and nice to be talking to everyone.
Good on you. Thanks, Kieran.
And thanks to everyone for listening to Current Market Insights. We look forward to speaking with you next time.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.